Imagine the peace of mind that comes with knowing your loved ones are financially protected by your life insurance policy. But what if, after years of faithfully paying premiums, there is a worry that a claim might not be honored? A common question we hear is whether an insurer can deny a claim even after a certain period of time has passed. Generally speaking, once your life insurance policy has passed its incontestability period, which is typically 1 or 2 years from its issue date, an insurer cannot deny a claim. This important feature is called the Incontestability Clause, and it is designed to provide security and certainty for policyholders and their beneficiaries. During the initial incontestability period, the insurance company has the right to investigate the information you provided on your application. They are looking for any material misrepresentations or omissions that might have affected their decision to issue the policy or the premium rate. However, once that period expires, their ability to challenge the validity of the policy based on those application details becomes very limited. The primary purpose of this clause is to prevent insurance companies from endlessly scrutinizing applications and then denying claims years later over minor details, thus offering peace of mind to beneficiaries during an already difficult time. There are, however, a few very specific situations where a claim might still be denied or adjusted, even after the incontestability period. The most common is the non-payment of premiums. If the policy simply lapsed because premiums were not paid, there is no active coverage. Another rare exception is deliberate, intentional fraud, not just an honest mistake. This is a very high legal bar for an insurer to prove, showing clear intent to deceive from the outset. Additionally, if there was a material misstatement of age or gender, the policy typically adjusts the payout to what the premiums paid would have purchased at the correct age or gender, rather than outright denying the claim. Most policies also include a separate suicide clause, often for the first 2 years, which may result in a denial if death occurs by suicide within that initial period. Furthermore, certain exclusions specified in the policy, such as death due to illegal activities or declared hazardous hobbies, can still apply regardless of the incontestability clause. The Incontestability Clause is a powerful consumer protection feature built into most life insurance policies. It essentially shifts the burden of discovery to the insurer within that initial period, preventing them from endlessly scrutinizing your application years down the line for minor inaccuracies. It distinguishes honest oversights from intentional deception, which is a much higher bar to prove after the period, and significantly reduces the risk of legitimate claims being disputed. Understanding the Incontestability Clause means you can have confidence that your life insurance policy will deliver on its promise when your family needs it most. By being truthful and thorough on your application and consistently paying your premiums, you ensure your beneficiaries are protected against future challenges, securing the financial future you intended for them.